Good morning and Jai Hind. In the previous video, we have learned liquidity ratios. In that, we have learned two types of ratios, current ratio and quick ratio. In this video, we are going to study two types of solvency ratio. In our syllabus, we have to study four types of solvency ratio, but in this video, I am going to cover two types of solvency ratio. The first solvency ratio is debt equity ratio. It indicates the proportion of funds which are acquired by long term borrowings in comparison to the shareholder funds. That means amount of funds which are acquired either by two means, one by long term borrowings and one by through shareholders. So we have to compare the these two type of liabilities with each other to know about their proportion, their ratio. And in debt equity ratio, we have to divide debt by equity to get the proportion between these two liabilities. In debts, or we may say long-term debts, long-term borrowings and long-term provisions are included, which matures after 1 year, like debentures, mortgage loan, bank loan, loan from financial institutions and public deposits. While in shareholder funds, it comprises of share capital and reserve funds. In share capital, we have to include both the equity and preference share capital. In reserve and surplus, capital reserve, security premium, general reserve, balance in statement of profit and loss are included. So, the ideal debt equity ratio is 2:1. But if the value of debt equity ratio increases, that means if the ratio is more, that means more funds are invested in a business, are provided by the long term lenders, and it is not good for the business. While if the ratio is lower, then it is more secure case. The next ratio which we are going to study is total asset to debt ratio. It is just a variation of the previous ratio, and it also gives the same indication just like the previous one only. It shows a comparison between the total assets and long term debts, and it is represented or calculated by dividing total assets with the long term debts. It is also represented in a pure ratio, just like the previous ratios we have studied, and we can we have to include various assets in total assets, just like non-current assets. In non-current assets, we have to include all the tangible assets, all the fixed assets which we can touch. Intangible assets, just like our goodwill and patents, copyrights. Non-current investment, that means all the fixed investment, that means those investments which are being done for more than 1 year. Long-term loan and advances which is given by the firm to someone else, plus all the current assets, just like debtors, bills payable, cash. All these comprises total assets. In debts, you have to include all the long-term borrowings and long-term provisions, as we have studied in the previous ratio, in which we have to include debentures, mortgage loan, bank loan, loan from financial institutions and public deposits, etc. Here we have to consider, we after calculation, whatever ratios come, if the value of that ratio is quite more enough, then it is good for the which could be considered good for the company. for the firm, as less debts has been included in purchasing the assets of the company. If the ratio is low, then it represents a risky financial position for the firm. With this, I am going to end my video. Thank you.